As it stands here today, it appears we've hit a local bottom in Bitcoin down at the $75,000 range, and we've recovered from that, and now we're bumping up against some serious resistance at the $88,000-$90,000 level, and we've got to kind of break through that mentally and hold that for this to stand. But I think that Bitcoin's catching a wave like similar to gold, where you've got investors who are putting money in both gold and Bitcoin, and that the US dollar being weaker is making Bitcoin stronger as well. And so it's a long way of saying that the decoupling, I appreciate it. I like it. I want to see it continue. And we're going to have to see, weeks and months of this for it to really hold.
The crypto market is heating up as Bitcoin teeters on the edge of a major breakout, or another frustrating rejection. After bouncing off a local bottom near $75,000, Bitcoin has clawed its way back up, only to slam into a formidable wall of resistance at the $88,000 to $90,000 range. This isn't just another price level, it's the line in the sand that could determine whether Bitcoin rockets into uncharted territory or gets knocked back down. The rally isn't happening in a vacuum. A softening US dollar and surging institutional interest are giving Bitcoin tailwinds, mirroring gold's recent surge as investors pile into both assets as hedges against economic uncertainty. But as analyst James Lavish points out, the real test is still ahead. The market has shown resilience, but breaking through 90K and holding it requires more than just momentum. It needs conviction. Traders are watching closely to see if this uptick is the start of a sustained decoupling from traditional markets, or just another fleeting rally. The stakes are high. If Bitcoin can cement itself above this critical resistance, it could trigger a fresh wave of FOMO and send prices soaring. But if it fails, we might be in for another grinding consolidation phase. One thing's certain, the next few weeks will be decisive. Buckle up, Bitcoin's next big move is coming. Let's watch more clips from James Lavish's explosive interview. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
The divergence from Bitcoin and risk-on assets like the NASDAQ and regular stocks, at the same time that bond yields are going down. Actually, I'm sorry, the bond yields are going up, so bonds are going down. So you would think that the flight of safety would be to bonds. And for people who are new to this whole game, when you buy bonds, you're buying them at above or below par, right? And if you buy it below par, that means you're buying it at a discount, which means that the interest rate you're effectively paid, because you're getting paid coupons on these things. Those coupons are set. So if you paid less for the bond, then that coupon becomes just a larger percentage. And so that's why yields go up when bonds go down. And that's kind of the way it works, right? So, but you would think stocks going down, well, then bond yields would probably be going down too, because bonds are going up, because that money would be flowing into safety assets, like the risk-free asset, which is the US Treasury. Not really risk-free. We know that. We talk about that all the time, but that's the quote on Wall Street. Risk-free is the US Treasury. It's not risk-free. We learned that the hard way during the pandemic, when we way overprinted money, not we, the central bank, the Fed, way overprinted money, caused massive inflation from the expansion of the money supply, massive asset inflation, massive inflation across financial assets. And because we're so financialized as a nation, everything went up in price, along with supply issues and supply chain issues and bottlenecks and all that. But that was kind of a goat that should have gone through the boa and gotten out the other side. It never did. And we had these this crazy inflation for years and years because of the expansion of the money supply. Let's just call it what it is. So you saw bond yields. What happened was bond yields spiked because Fed funds went up and bond yields went up in order to compensate investors for that high inflation. So if you're a bond trader, you're not going to buy a 10-year treasury at 2% if inflation's at 5%. You want to be compensated for that. And so when that interest rate goes up, the bond price goes down, and all these banks, all these community banks that were holding these treasuries got absolutely annihilated. And that's ultimately what caused the collapse of Silicon Valley Bank 2 years ago. And that's kind of, if people remember back, well, that's not risk-free to me. That sounds risky to me. It's risk-free in the sense that, yeah, if you hold it to maturity, it's a non-zero probability that the U.S. will hard default on that, but it's about as close to zero as you can think of, because the U.S. Treasury has the ability to team up with the Fed and print money to buy its own bonds. So of course they're not going to default. They're just going to print money and make sure that these things are always trading. And so, that's it's called the soft default. And that soft default is inflation through expansion of the money supply, which is debasing the U.S. currency every single day in order to keep this whole debt charade going. And that's kind of the point, right? Big picture, what's been happening? Well, Trump has threatened to enact to enforce these tariffs on all these countries, and big tariffs. And so that has caused quite a bit of angst for a number of reasons. There's angst with people who import materials and goods to sell here in the United States. So you getting some misinformation of the actual demand, the underlying demand of the economy, because you've got manufacturers and suppliers who are importing goods in order to get ahead of that tariff. The underlying economy has not been doing that great. There's a lot of negative indicators out there. And so we're just watching these things and seeing if they continue to kind of snowball, especially things like the unemployment rate, now that you've got government jobs coming out and all of that. But so you've got the economy is clearly softening. You've got cross current of information of what are the actual trade numbers, what are the actual purchasing and index and the PPI and all that. Like what's PMI, all like what are all these telling us? And then at the same time, you've got investors who are worried that the earnings of companies are going to get negatively impacted. At the same time, you've got bond investors worried that, well, if we're going to, hammer China with these huge tariffs, they're going to turn around and they're going to shore up their own currency, and they're going to turn around, and the way they do that is by selling treasuries that they have. So if they sell U.S. treasuries, what does that make the treasury do? It goes down in price and yields go up, something we may be seeing here, right? And so, or it could be traders getting ahead of that, worried about that scenario where China starts selling bonds, and not just China, other countries too, selling U.S. treasuries in order to get dollars to sell those dollars and buy their own currencies. Those are possibilities. You're seeing the dollar go down in value against other currencies across the board here. The DXY is down, and that suggests some of this is happening, or just the confidence in the U.S. dollar, the U.S. Treasury is waning. That's all happening. And then you layer on top of it, Marty, that basis trade I was talking about. And that's kind of like the powder keg that is behind the scenes that the very, very intelligent investors know about. They understand it, and they're watching carefully. They're watching credit spreads. They're watching the spreads of the bonds to the futures, the bond futures, and they're gauging whether or not this trade has is going down the path of blowing up in hedge funds' faces. We're watching all this, and I don't know if these trades are being unwound, but I can tell you that there are hedge funds that are anticipating problems of other hedge funds with them, and so they're getting out of some of these trades, and that's why you're seeing some of the movement in the yields, I believe. And so, but what's happening is, and what's so important about this is that this is to get an idea of how impactful and how explosive this trade is. They had the Brookings Institution For those of you who don't know what that is, it's a think tank out of DC. And it's basically a tacit research arm of the Fed. I mean, it's a very strong statement, but what I mean by that is that there are a lot of former Fed officials that work at Brookings Institution, and they research and float ideas and policy there to kind of see how they're received, and what people think about it and what the Fed thinks about it. And so for instance, they did, and I've said this before, the Somm rule, the Claudia Somm worked at Brookings Institution. She was a lower Fed official. She worked at Brookings Institution. She came up with something called the Somm rule, which is that unemployment rate rule that to keep the numbers very simple for everybody, basically if the unemployment rate goes up by more than 0.5% from the bottom in a cycle, that means we're in a recession. We've gotten very close to that. But that's a rule that the Fed looks at now. That's something they use as a gauge to say, okay, we're in recession. We've got to lower rates. They haven't seen it yet. It's very close, but that came out of the Brookings Institution.
The crypto markets just erupted in a historic liquidation frenzy, vaporizing over 500 million in short positions as Bitcoin's unstoppable rally left traders in chaos. The next critical battleground? 95,000. A potential pause point before the final assault on the ultimate psychological fortress, $100,000. But this isn't just another price swing, it's the beginning of a monetary revolution. The total crypto market cap has exploded past $3 trillion, matching the dizzying heights of the 2021 bull run. But this time, the momentum is different. Macroeconomic forces are aligning like never before. 10-year Treasury yields nearing 4%, the Federal Reserve signaling 3 to 4 rate cuts by year-end, and global liquidity surging at a pace unseen since Bitcoin's early days. The stage is set for an unprecedented financial shift. And the most electrifying prediction? Bitcoin could double before 2025, soaring to $200,000, a move that would cement its status as the ultimate store of value. But the real shockwave? Investors are no longer treating crypto as a speculative gamble, they're flocking to it as a hedge against systemic risk. As traditional markets wobble under inflation, debt crises, and geopolitical turmoil, Bitcoin is emerging as the 21st century safe haven. Let's watch more clips from the interview.
Is there any feasible way to unwind that trade outside of overt intervention from the Fed?
Not rapidly, not quickly. I mean, it could be catastrophic to the market. Yeah. So you've got it. I would imagine some of these, some of them are unwinding some of it, but I'd also imagine, Marty, that you've got hedge funds who are stepping into it, like they're looking for opportunity. If they see an opportunity, they think that they can stomach, they're going to step into it. So it might just be moving from book to book. We don't know. It's hard to tell. And so much of it is on swap. It's hard to tell. We're so financialized, like I was saying, as a country, as an economy. If the stock market blows up, really blows up, we are headed for a deep recession. And the only way we can pull out of that is by printing more money. So what happens to bond yields? Bond yields will go up in that scenario because the bond traders, the vigilantes, are going to want to be compensated for the clear and obvious inflation that's going to come from another expansion of the money supply. And so that's the issue here. So do bond yields go down to 2% because we just slowly grind into a recession here? Or do they spike up to 5-6% because we have blown up the economy and the Fed's turning around and printing money to oblivion to save it? It's a good question. And that's why you're seeing a lot of uncertainty in the market. People don't know where we are on that spectrum. And some of it has to do with, headlines and a tweet, from Trump. He could just tweet something that just spooks the market to the point where, you have the NASDAQ sell off 3 or 4%. Oh, well, look at that. It's down 2.5% today. It was down over 3% earlier, I believe. The telling thing is that bonds are not acting like they should as a flight to safety. That's number one. And number two, gold is absolutely ripping higher, rocketing higher, because it is a flight to safety. And investors are looking for a place to put money to just protect it. And gold has been a strong store of value for centuries. And now we get to the question about Bitcoin. And Bitcoin diverging today is very interesting. It's interesting because is it following gold? Is it finally, are people just realizing, like you said, that arbitrage, is that closing, that understanding arbitrage? Is it just because the dollar is so weak, which means that the dollar Bitcoin price goes up? That's part of it. We were talking this morning on a different show, on the Macro Monday show, and Dave Weisberg brought up a great point that over the weekend, Charles Schwab talked about having a platform to trade crypto. And, I've been talking about this for a number of months now, that SAB 121, the full repeal of that through issuing SAB 122, for those who do not know what I'm talking about, this is where the Fed a couple of years ago did an end zone run around legislation, and they put out this bulletin that basically said that banks had to hold Bitcoin as had to hold Bitcoin and crypto as a liability on their balance sheet, even if it was just on the customer's account. So it basically prevented banks from dealing at all in crypto. And this was kind of an aspect of choke point 2.0, where they just didn't want the banks to be involved. And, you can kind of speculate who would be driving that. But up in DC, it's clear that Elizabeth Warren and her anti-crypto army were a very big part of all this. Because when the Fed did that, and then a number of months later, almost a year later, I think, Congress met, and both Congress and the Senate passed legislation to repeal SAB 121, which is that bulletin. And then it got to Biden's desk, and he vetoed the repeal. And that was clearly he was pushed and advised by that psycho, the psychopath from Massachusetts, Elizabeth Warren, who she has done nothing good for this country, clearly. Just a lot of talk and a lot of, money going into her pockets. Insane. I don't know how Massachusetts keeps voting for that person, but in any case, he was advised by her team and other teams to repeal it, to veto that repeal. Finally, we get Trump come in. Trump comes into the office. Gensler resigns. A new bulletin comes out, SAB 122, that repeals SAB 121 and says that banks can own and hold crypto and Bitcoin for customers without having to put it in as a liability on their balance sheet. And so now that's a very, 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 very big deal. It's a really big deal because you will have banks like Chase and Citigroup and Wells Fargo start dabbling into this space, especially in Bitcoin. And I expect other ones. I expect Ethereum and Solana and other ones, but they're going to start dabbling in these and allowing customers to buy and hold them right there at the bank, which is new. This is huge, because you don't need a brokerage account. You can do it right there. You can do it right to your bank there, and they'll hold it for you. Like, this is going to be a big deal. And I think it's underappreciated just how important it is that banks will now get into this game. And this is part of the first they fight you, right? And then at the end they join you, and here they are. They're right on the cusp of that, and that's a big deal. So that could be part of this too. But I think it's a combination of things, Marty. First of all, I think unless we get another meltdown of the market where everything correlates to one, and that's just reality. The only thing that may not go down in that case is gold, but I think that even gold would, because when everything correlates to one, it means that you're getting margin calls everywhere, and you sell what you can, not what you want to, and so everything ends up going down because you have to get cash to meet margin calls because everybody's levered. So in that case, Bitcoin will go down.
The crypto market stands at a pivotal moment as Bitcoin's surge past $95,000 returns short-term holders to profitability, a classic precursor to major rallies. Data reveals long-term investors have quietly accumulated 363,000 Bitcoin since February, while April saw fresh capital enter at higher prices. This accumulation phase mirrors what analyst James Lavish has described as Bitcoin's evolving role as digital gold, particularly as it decouples from traditional risk assets. Yet significant hurdles remain. A dense cluster of 392,000 Bitcoin, acquired near $97,000, creates a formidable resistance zone where break-even sellers may emerge. Market structure suggests this could trigger either a healthy consolidation or a steeper correction. The Wyckoff accumulation pattern spotted by traders hints at ambitious targets reaching $166,000. But first, Bitcoin must decisively overcome the $96,100 barrier where medium-term holders traditionally take profits. This rally diverges meaningfully from past cycles. Unlike 2021's retail-driven mania, current momentum stems from institutional adoption following the SAB 121 repeal, allowing major banks to custody crypto. Meanwhile, macroeconomic cross-currents, including dollar weakness and bond market turmoil, amplify Bitcoin's appeal as an uncorrelated asset. The path to $100,000 now hinges on whether new institutional demand can absorb potential profit-taking. With on-chain metrics showing strong holder conviction and whales absorbing 300% of annual issuance, the foundation appears solid. Yet in crypto's volatile world, only time will tell if this is the final push before price discovery, or another fake-out before deeper retracement. One thing is certain, the coming weeks will test Bitcoin's maturity as an asset class. As we wrap up, do you think Bitcoin will smash through $100,000 this cycle, or are we due for a major correction first? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.